Hello traders, Gary Wagner here. It is Friday, finally the 24th day of June. Markets in gold are closed. This is the daily report and weekend review for gold. Under another very aggressive round of selling, the market did close actually breaking below the psychological $1,500 barrier. COMEX was 1498.50 and Forex or cash was 1497 today. We're looking at a daily chart in which I have my long-term trend line put in here, and as you can quite easily see, not only did we get a close below it, but we got follow through on today's trading activity. In fact, when you take a look at the pattern that is formed in terms of candlesticks themselves, you get this star-like character. You can see how that's gapped above it. You get that follow through and then confirmation. It is what I will call a variation off of the Three River Morning Star. Now, in the marketplace itself, we had what I believe to be, as I talked about yesterday, a fundamental game changer. And what I mean by that is that the fact that Greece came out and announced that they will do the necessary budget cuts to secure a restructuring loan signals to the world that the domino effect that could have been created by the inability of Greece to come up with some sort of a compromise, a solution, would signal a potential domino effect that could spread all across the European Union. That was thwarted, in my belief, by the actions and the statements not only of the European Union, but more importantly of Greece itself. Now, I'm going to be talking about a couple of things today. It should be an extended report, so bear with me, traders, because we have a lot to say and a lot to cover. Now, in terms of our position itself, if you're trading into COMEX, you did not get stopped out. If you're trading in the cash market, you in fact did get stopped out. I will work with the fact that we did get stopped out. It came too close. In terms of a Forex trade or a spot trade, there's absolutely no doubt. You had 97 being the low. Our stop was at 98. So we will look at it from that vantage point on today's daily report. Now, here's what I believe. I personally believe that we have had on this fifth wave what is called a fifth wave failure. Let me put the chart up for us. Traders, this is the chart we have been using for our basic Elliott wave count itself. And it is well documented by R.N. Elliott that there is a cycle which is basically called a fifth wave failure. A fifth wave failure is when you have the absolute inability for that fifth wave to carry on and to trade really above wave 3. As you can see, what I was looking at, this is the beginning. This is 3 to 4 right in here. It seems as though we had a 3 count, not a 5 count, but we had 1, 2, and 3. You can see that on this fifth wave itself, it had the inability, of course, to track and trade above that 1577 area. And this last couple of days, because it has broken below this particular low right in here, does signal to me the potential that what we are looking at right now is simply called a fifth wave failure. What does that mean? Well, what that does mean is if in fact that is the case, we will now go into a corrective stage. A corrective stage, of course, is going to be an A, B, C correction. Now, in terms of actually charting where we think the correction might go, I want to wait until Sunday and Monday. I want to see if, in fact, we get a follow-through, because we did close above an incredibly important psychological area. It did break below, but that $1,500 mark is extremely important. It's extremely important. My sentiment was that 1501 to 1503, that's major support, and of course major resistance. We had two major resistance, the record top at 77, and then 1551 was that critical area that we needed to break through. As you can see, we certainly didn't break through this. This became a ceiling. We didn't even get close to that record top. And so now the question is going to be, is the market here going to find some support, or are we going to see some kind of follow-through selling in this market? On that, something like that, we're going to have to wait to see if we get follow-through. But what is important now is the fact that, at least in my opinion, we have had a failure of this fifth wave because, as I said, when we take a look at the way that this wave really actualized with 1 and 2, this 2 giving us low right in here, once that marketplace on 3 came up, but we had this failure right in here, really, in terms of a long-term trend, we could easily see it move to this lower channel line and then begin to move up, or it could begin to break down. If it breaks down, we will see a series of new lows. Now, in terms of where, let's take an assumption. Let's work with the assumption that we do see a correction within this area. Well, where might that correction itself take us? The first thing that we want to do is take a look from the beginning of February when the marketplace did bottom out. This is right after our January correction. It came to our top, which is, call it 1577, right in here. Try to line that up for us, traders. And then what we want to do is take a look at where, in fact, some logical corrective points might come to. And so what we're going to want to look at is, you can see that it's already gone past our 23% level. And so really what we want to look at is the 38%. Where is that going to take the market to? And I think that we're probably close to it. We also want to take a look at the 50, and we want to take a look at the 61%. So we want to look at all of these particular target areas so that we can ascertain where, in fact, this market could go. As you can see, the 23% level, which is 1516, we've absolutely breached that area. Now, this is a much longer term look at the market because we're looking at some pretty deep corrections. You can also see that there's really good support here at 1479, 1480, right in here. And that would be our 38% level. Again, traders, realize I'm looking at a pretty big Fibonacci corrective level in terms of the area or target area that I'm looking at. I'm looking at this entire swing that we've had, pretty much the year in trading itself. So that it might be logical, if in fact we do go into a correction, when we take a look at this area, to see that market correct to a 38% retracement area. That would take it, of course, under 1500 to 1479, and then a 50% area would take it to a target of around 1450, the actual number being about 1448, and that's at 50% level right in here. As I said, I believe it's a little bit too early to tell, but we certainly had the kind of follow through today, which to me signals a failure of our fifth wave. We'll have to take a look throughout next week to see if we absolutely get confirmation of that. But it does appear clear to me right now that this most recent trading activity, and as I said yesterday, I believe that some of the fundamental news that we saw in the market was basically a game changer. But what we really have to be cognizant of is the big budget deficit, the big elephant in the room, as I talked about yesterday, is how we're going to handle the U.S. debt ceiling. And we realize that in order to keep everything running, they're going to have to raise the ceiling, but they're going to have and show some fiscal responsibility, which is basic budget cutting. And that will determine, I believe, the future of where we see gold trade through the summer itself. This has been Gary Wagner, wishing you, as always, good trading, and we'll talk to you next week for another daily update and review. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange